First up, we're going to have a little bit of a video. So I'd like to introduce via a short video Tim Bennett, CEO of New Zealand Stock Exchange, via YouTube, to talk about New Zealand Stock Exchange initiatives around making the listing process easier for angel-backed companies. So if we just play that.
Hello everyone and welcome to New Zealand, and in particular welcome to the spectacular scenery of Queenstown, New Zealand's global tourist destination. Of course, New Zealand's not all about the beautiful scenery. Over the past 5 years we've had a spectacular run in our capital markets. Partly that's been driven by the recovery from the global financial crisis, but more importantly by three factors that will continue for some time to come. The first of those is regulation. The Financial Markets Authority was established about 4 years ago to overhaul the regulatory landscape in New Zealand. We are a small, well-regulated economy for you to invest in. The second thing that is transforming our markets is the introduction of a savings scheme, KiwiSaver. From a zero start about 5 years ago, that now has close to 30 billion assets under management, and Treasury expects that will grow to around 70 billion by 2020. New Zealanders are saving more. And of course, we welcome foreign investment. Foreign investment in New Zealand in 2014 was around $7 or $8 billion. So clearly there's a large pool of capital to invest or be invested in New Zealand. But importantly, for our economy and for you, we have a great group of highly innovative small companies that are seeking that capital to grow. There are plenty of opportunities here for you and also to establish funds to capture some of that investment that I just talked about. At NZX, we've made some changes over the last few years to make it easier for companies at the right stage of development to go through an initial public offering. In addition to crowdfunding, which we don't participate in, which has allowed equity raising up to $2 million a year, we've established a complementary market called Next. It's a different form of regulation to what we have on our main market, and is designed for high growth companies with a market capitalisation of somewhere between $10 and $50 million. It's got some unique features, in a lot of ways taking the angel or venture capital investment model to the public markets as a stepping stone to our main board. And that main board has been successful in growing in size over the last 5 years, from under 40% of GDP to close to $100 billion today. That's just over 45% of New Zealand's gross domestic product. So while the last 5 years has been terrific in New Zealand's capital markets, I firmly believe that we're at the beginning of what will be a 15 or 20 year journey to provide a deep public market for companies to list. Please enjoy your time in New Zealand, and we look forward to connecting with you as you invest in our great country.
So that was a nice scene setter. It's my pleasure now to hand over to Twiss from the NZVif, and he'll moderate the remainder of this session.
I think the essence of this session is actually about not only a particular source of capital, or how this IPO source of capital sits with all the others, but also have a real sense of mobility of capital. So it's appropriate that we should have a pre-recorded message, and we should be joined by Skype from a distant and exotic location, Auckland, by a company called Adherium, which is a very wonderful recent exit for many in the angel and private investment community in New Zealand. So this is of course not rehearsed, and so right about now there should be a Skype screen behind me. Oh, there they are, right, great. So what we're going to do is just kick off. If I could perhaps ask Garth and Bronwyn to just focus on Adherium's recent journey for 5 or 10 minutes, something of the background of their road to IPO, listed on the Australian Stock Exchange in August this year, and maybe just some highlights for them, some key observations and lessons from the latter stages of that road and the actual IPO process itself. So, and then we'll turn it over for some question times with Garth and Bronwyn and Ron and David as well, and then finish off with some question time from you. So Garth and Bronwyn, could I ask you to kick off with just a bit of a backstory on Adherium and some key lessons and observations from your recent listing?
Well, good afternoon, everyone. It's a pleasure to be at the conference virtually. My name's Garth Sutherland. I'm the founder of Adherium, and my pleasure to introduce Bronwyn McGrayth. Bronwyn is our Head of Commercial Development and our Company Secretary in Australia. Can everyone hear okay? Chris, is that coming through okay?
I think we're good. Yep, thanks, Garth.
Good, okay. So look, I'll just tell you a little bit about Adherium. We are a digital health company, and we manufacture we're a designer and a manufacturer of a technology called Smart Inhaler. And Smart Inhaler is a digital health technology that comprises a sensor that attaches to a patient's inhaler that is used for the treatment of respiratory diseases such as asthma or COPD. And that sensor collects data on medication usage, so it tracks how the patient is using their inhaler, uploads it to an app, and then through to the cloud. Our company was, we've been originally through the angel investment process. So we originally raised angel capital when we were in the Icehouse incubator in Parnell, and we were one of the first companies to raise capital from the Ice Angel network. When we raised that capital, we had a number of other funds who also participated, including the New Zealand Venture Investment Fund, the Seed Co-Investment Fund, Cure Kids Ventures, Sir Stephen's Fund K1W1, and Endeavour ICAP. And we went through a couple of rounds of angel funding, and then we moved on to a round of venture capital funding, at which point in time an Australian venture capital group by the name of Bioscience Managers invested in the company. They're out of Melbourne and became a cornerstone investor. But with each of those rounds, our existing shareholders, we had great participation from our existing shareholders, such as K1W1 and Cure Kids Ventures and the Ice Angels and so on. Typically about more than 50% of our existing shareholders came along into each new round. That last round of venture capital funding was in February 2003, and then we went on and we listed in August of this year, and at which point in time we raised 35 million Australian dollars. It was a very, very successful IPO. Bronwyn will tell you more about that because Bronwyn was project manager for the IPO process. It was a very clean IPO, and the company had no debt going into that process, so we raised significant growth capital. At that point, I will just stop there and just hand it over to Bron.
Hi everyone. Just picking up on from where Garth was, I think the decision to list was quite an objective decision taken by the board. We, as a group, undertook market soundings in a number of markets, New Zealand, Australia, the UK, as to find the right fit advisor and in market that had the analyst coverage of the sector, the knowledgeable investors who are experienced in the healthcare sector, which has some specific requirements, had the capacity to raise a substantial sum of money. And we knew we were looking at north of 20 million, but we didn't know what exactly our maximum would be at that point. It was quite early in the process. I think going through the experience, I can only speak as the project manager. It wasn't my first rodeo. IPOs are very grueling. They're quite distracting to the management team. They involve a lot of retrospective cleaning of house, so going back and going through all contracts and all invoicing and all financials and re-auditing and ensuring that you can meet listing requirements on listing. but also so that once you go through that process, that there's no risk of anything from your past coming back to bite you in your future as a listed company. It's an expensive process, and it's a process that you don't want to undertake unless you've got a really high probability of success. It's expensive, and if you don't get to the market and you don't raise the required capital, that's a sunk cost that you can't recover. So we chose the ASX because we had a lot of competition from investment banks. Business was deemed to be the right stage of development for the healthcare sector in Australia, probably a bit early for the UK. The Australian sector is interested in life sciences. In a listed sense, it's probably the leading market for growth healthcare in the Asia-Pac region. It's got well over 100 listed companies. In 2014, it raised over $4 billion of IPO funds into the healthcare sector. About $2 billion of that was aged care. Another $2 billion was technology and services and biotech companies. So there was a good momentum for IPOs in the sector, and we had a really strong broker in Bell Potter. And that's probably from the IPO front, that it was well received. It was more than 2 times oversubscribed. From a capital raising perspective, it was probably a dream run, but a lot of work went into making it like that.
Great. Thanks, Garth and Bronwyn. Perhaps just as a scene setter too, just to put it in context, this IPO choice amongst raising capital for your company. I just talked a little bit of the New Zealand situation. So New Zealand Venture Investment Fund, government-backed fund that's been investing in early stage companies through a venture capital program and an angel program for about 13 years now, has a portfolio of nearly 200 companies, of which about 5% are now listed on stock exchanges in New Zealand, Australia and the UK. So just quickly, David and Ron, how does that sort of compare, just to sort of compare the greater China region and the US in terms of how prevalent the IPO option is in the sort of set of companies that you're familiar with? Yeah.
Well, it's very unusual for us to be talking in the same breath about angel-backed companies and IPO because it's a rare event. Even for venture-backed companies in the US, 5% typically exit via IPO versus M&A. And so if an angel-backed, if I was looking as an angel at a company and they said, well, what's your exit strategy? They said, we're planning on IPOing. My reaction would be, please stay on your meds because it really is a rare event. If it happens, it's wonderful. But the way things work in the US is just the opposite. The IPO market influences the angel environment, not the other way around. When pension funds see lots of good returns from venture, there's a lot more venture capital that pours into early stage companies. That helps the angel economy a lot because there's a next round of funding, and angels themselves are more willing to invest. So it's the other way around. The IPO market influences us. If we manage to IPO, it's a wonderful and unusual event. I have 3 companies now about to register. And that's probably unheard of. And we can talk a minute about the current terrible state of the US IPO market, but that's for later.
Okay, thanks, Ron. So 5%, there's a common denominator there with New Zealand. And David? Prevalence?
I would agree with Ron coming from a US perspective, but I can also give another perspective, which is that of the capital markets in China, which is certainly much younger in terms of its growth, in terms of its mindset, vis-a-vis the United States, right? And so coming from an angel investment background, yes, you're lucky if you can IPO, the typical exit is trade sale. But in China, you think about going public, the concept has only been around for, let's say, a decade or so, right? So when I talk to people about investing in companies and say, well, how do you get out? Is it IPO, right? And then you talk to private company owners from early stage to late stage, and they say they want IPO. That seems that's the holy grail, right? And people should realize that the IPO is really an event. It's another capital raising event. It's not the goal. But from what I've seen by living in China for the past decade is that people kind of treat the IPO as an event, and then as a goal, and then they stop, right? But that should not be the case for sure. Having said that, we do angel investing in China, right? So when I hear people say, well, we want to IPO, well, the question is how? How is that possible? And with the traditional A-share board in Shanghai, it takes a longer time. But now, in recent years, there's something called the new third board, or Chinext, based in Shenzhen. It makes the entry barrier to list much easier. It only requires 2 years of operating history and very little financial results to be able to show to kind of get to this new third board. And it's similar to an OTC exchange in some other markets. And you can list, yes, that technically is possible. But the question is, can you get liquidity? Can you get research coverage? Can you get float on your stock? And the answer is not at this point, right? So a lot of people may list, but they may be highly disappointed. But I think the IPO, the public market concept is certainly out there, and it becomes something of an appeal for many people who are running companies. But certainly as investors, as private investors, I think we should know better to be able to kind of jump on the bandwagon and say, yes, the exit is the IPO, because I don't think it is, from my perspective.
Certainly, and Adherium are a great example of this, of course, but my strong sense is that the mobility of New Zealand companies in terms of their view of the world and actually doing their research on which market might be the most appropriate is going to be on the increase. So they'll certainly look at the New Zealand option, but feel very free to look at others around the world as well. I mean, actually, Bronwyn and Garth, I mean, how many markets did you look at? How many exchanges did you consider?
Probably 3, seriously.
Yeah, okay.
So AIM, NZX and ASX.
Yeah, okay. And David and Ron, do you see the same sort of mobility, or is there much more sort of closer to home activity in terms of the US or China? Do you think there's that people are also looking outside of those regions in some cases to see what the best option for their company is? Yeah.
Well, in terms of the US market, there really are only a couple of exchanges that US investors really care about, and that's the New York Stock Exchange, which is increasingly popular for tech companies, and NASDAQ. And everything else is a strategy to keep afloat. The London, some of the small London exchanges, for example, are simply gap-filling strategies. Right. I just want to comment on something David said. He said something extremely important. An IPO is not an end. It's actually the beginning. When you IPO, you're setting the stage to the next growth phase of the company. Otherwise, why would an investor trade dollars or yen for shares in a company that viewed it had just reached an end of a process as it goes to a start? So if you ever see a CEO who is looking to IPO as an end goal and that they're done, that's a great reason not to look at that CEO any further, because they profoundly don't get it.
So back to your question about which exchange in China, the RMB currency is not freely convertible, or has not been, or now is becoming more so, but certainly 5 years ago, it was not freely convertible. So if you're setting up shop in China, either you're a local Chinese company with primarily Chinese shareholders, or you could be a foreign owned company with a WFI structure, we call it, through Hong Kong and maybe an offshore Cayman or BVI, right? And those are US dollar investors. So if you're one of those, if you're one of the foreign-owned structures, then the primary path for exit, if you're going to the public markets, is overseas, Hong Kong or New York, right? And we've seen many examples of Chinese companies that were under this structure, the WFI kind of offshore structure that went public in New York, such as Alibaba, one of the most successful IPOs of all time. They raised $25 billion, right, in an IPO. Otherwise, you're on the other camp, the local Chinese, structure where you kind of list in China. Both were kind of okay, but for a while, the US option was attractive because the listing requirements were based on capital markets. It wasn't based on regulatory constraints that the government could place on you. In the last couple of years, what I've seen is that it's kind of reversed the trend, because if you look at the companies that went public in New York versus China, the PE multiples have been drastically different, right? So in New York, I don't know what the multiples are these days, but when I looked at some of the stats for 2014, the average multiple for PE multiples like between 20 and 29. In 2012, it was between 30 and 39, actually, in the 30s. Now it's come down to the 20s, so we're getting lower. But certainly a PE multiple of 25, let's say, versus 15 on NASDAQ makes China much more attractive as a capital market. So it depends on how you're structured, number one, and secondly, it depends on what market you think you can achieve. I see what I see now is that a lot of Chinese companies that were listed in New York, they want to come back to China because they can get higher multiples, actually. Yeah.
There's one more factor here. How many people remember 2000, were active investors in 2000? Well, there were any number, you will hopefully share my bad memory. One of the questions is the volatility of the smaller exchanges. So after 2000, certainly the big exchanges in New York and London got hit. But the Nouveau Marché in France and the Neue Markt in Germany lost more than 90% of their value. You know, we lost about 40% of our value. They lost 90%. So if you're listing on those exchanges, you could be really, really, really vulnerable. The float on those exchanges is also very small.
Yeah.
So it's, you know, it's tougher to make a market.
Yeah.
So there are lots of reasons to pick an exchange, but look at what happens in bad years, not only what happens in good years.
So as I see the commonality there, we're talking the exception rather than the rule in New Zealand and most other markets I can see. So just thinking about in the earlier stages of a company's life, and Garth, you can talk to this from a personal perspective, you know, how much time, if at all, should the founding team and or the board be giving in terms of consideration of IPO as an option down the track? And maybe if I'll let, or maybe if you, Garth, if you could start there. Is this something you sort of dreamt about in the mid-2000s, or just, you know, something that you looked at more recently? Yeah.
You know, well, it's always been an option, and I've worked in the tech sector for over 25 years, so it's a capital raising option we always knew about. But I don't think it was a big focus for us earlier on. In the earlier stages, we were just focused on, you know, more of the building the company and going through the angel investment rounds, which we've, you know, looking back, were just great rehearsal for leading up to an IPO process. So, no, we weren't. We were more focused on building the business and getting our product and getting our customers, but from a capital raising perspective, leveraging the network that was available to us through the Ice House and through the Ice Angels, and also through Venture Investment Fund, K1W1, Cure Kids, and all, you know, the funds that were available on our doorstep.
Yeah. Okay, great. Thanks, Garth. Ron, just in terms of how much time at all in the earlier stages?
We want our companies to be thinking about exits. And at the point at which we invest, we'd like to know roughly how and when we're going to get our money back. But that's a 7-8 year journey. And the proper time to think about IPOs is roughly 2 to 3 years before you're really ready to go out, because you need to radically change how you operate. But before that, I wouldn't want management to spend even 1 minute thinking about IPOs, except as a long-term motivational goal. I would want them to think about who they're going to date in terms of a likely M&A partner. And by the way, the best way to get acquired is to do a listing or threaten to do a listing, because buyers know that if you go out, you'll be much more expensive. So in the US, you often use an IPO listing to solidify the interest of a couple of buyers and get a real M&A auction going.
Yeah, I mean, you know, as angel investors, we invest really early stage, and it's kind of hard to predict whether the company can go IPO, let alone raise the next round of funding, right? You know, so I think for us, we're of a different mindset than the VCs. The VCs that run institutional money, they got to go for the home run. They got to go for the IPO, right? For us, you know, we can go doubles, triples, okay. Trade sale, not a problem. If I get 5x on a deal within 2 years, that's pretty good, right? But the VC is not good enough. So I think the mindset of angel investors in this room are probably drastically different than the venture capital guys that need to go for the public listing.
There is one, let's say there's one difference here, and that is if you're a biotech investor, IPO is much more of a mid-stage fundraising strategy than it is in any other sector. So these comments don't really apply to the biotech sector. Ask Alan May for guidance here. But many biotech companies I've looked at do have an IPO as a mid-stage funding strategy, and that's very common.
Just in the Adherium IPO, did anyone exit at that point? Garth, was it all new money? Well, I know obviously some parties are still in a lock-up, but was there some realisation?
So we had investors, angel investors who had been in for some time. One of the funds had actually closed in that time, so at that point they exited. But you know, you're in a public environment, so that's an option for people. From that perspective, I think we Ron and the team did a great job, and the Bell Potter team did a great job. We had upon closing, we had 2 times the level of demand on our equity that we had in terms of issue. So that didn't create any issue for us in terms of price or anything like that. So, but yes, we did, and you can have a look at the volume trading graphs on the ASX colon ADR to have a look at that. That was pretty pretty quickly cleaned out, I'd say.
Yeah. Okay.
I'd like to offer another perspective on IPOs. And, we're talking a lot about collaboration and cross-border investing, cross-border stuff, right? One thing that I've come across recently is that, as you think about a public listing, don't just think about your own market, think about other markets. One thing that I'm playing with in terms of a model is, in China, the public markets in China encourage foreign companies to list, especially if you have some IP or technology that are not dormant to the Chinese market. So let's say we take a Kiwi company that has some great technology, that's got markets outside of New Zealand, and maybe through this new third board market, we can help you establish a joint venture entity in China, which becomes a listable vehicle, right? And then, let's say 2 years later, you establish operations. That would become another alternative to listing, not in your home market, but in another market, which would be, welcoming, number one, and number two, would give you higher multiples than, let's say, your home market. That could be a viable option where, let's say, you can go to China and actually list, right? And you can actually obtain liquidity for your investors.
I'm Simon Small. I've just been involved in listing companies in New Zealand, Australia, and the UK. One of the things that a UK company that I'm a director of is thinking of is depository instruments in different markets. Now, is that something that you can do in China? So that it's listed outside of China, but there's a depository instrument there so that local investors can invest locally. You can do it in the US, you can do it in the UK. Can you do that in China yet?
Yeah, we don't have those instruments in China today. There's no equivalent of an ADR, for example, in China today. But certainly, I think the Chinese capital markets, the regulators encourage local listing, but not through another instrument just because you're listed somewhere else, actually.
Question for you guys and Adherium. What sort of lockup was there? What sort of escrow around the angel, particularly the angel investors?
Garth, did you get that? Stephen's just asked, yeah.
Yeah, the escrow, there was two types of escrow in the Adherium IPO. One is an escrow calculation that's imposed by the ASX, and we can provide them with information, but they ultimately make a call on what category each investor falls into and whether or not the market themselves will lock up that investor. They apply what's called the cash formula, so not all the shares are locked up, but a good chunk are, and we had primary investors that were locked up for 24 months. In addition, to ensure that there was a pretty orderly market in the shares, the broker asked for a post-listing threshold of 2% and up to be locked up for 12 months on a voluntary basis, which we put in place. And that's just to stop any untoward share price volatility. But none of our investors sold out, I guess, in the IPO process. All the trading that was done was non-locked up shares post the listing. And that was managed by the retail advisors at Bell's, the retail and institutional advisors at Bell Potter.
So what's the perspective, positive and negative, about reverse listing angel-backed companies onto a market? So especially on the ASX at the moment, there's a number of shells and seems to be interest in reverse listing some angel-backed assets.
What's the interest in sort of reverse listing? So, listing into an existing, at least you're listing through an existing vehicle on exchange. Is that common in the US?
Not really.
No. Yeah. David?
Well, actually, there was this huge wave of reverse mergers a couple of years ago into US vehicles by Chinese companies, right? And there are a lot of these, advisor or banker type folks trying to get Chinese companies to list via this reverse merger thing. And from what we've seen in the last, 2 years, it's kind of exploded in people's faces because they turned out to be very fraudulent. And, all these companies that kind of, quote unquote, got listed easily in the United States, I mean, there was a lot of issues with bad reporting and or fraud, right? So as a result, people have gotten burned and people have gotten sued big time as a result.
As the one case that we are seeing is there's an increasing number of private equity exits in addition to M&A and IPO. And some of those private equity exits are roll-ups, and we sometimes see reverse mergers of various sorts where the non-obvious company might actually be in charge because it has the superior management team. So you might see some financial or legal engineering around that kind of a roll-up, and that's becoming more common.
I'm interested in the governance of companies that have been angel and VC backed and have had obviously very active boards that are supporting the growth, and once a company lists, clearly there are a different set of both obligations but also the way in which that governance structure needs necessarily to change. So interested both in terms of Adherium specifically, but also from the other two panellists, what their experience has been around that and whether there are specific issues that companies need to pay attention to as they move towards that if it's an IPO.
I agree with John that the fundraising is a continuous process from angel stage to beyond IPO. And then to your question about governance, I'm on the board of a couple of my companies, and they're early stage still. But the boards change, right? So the board composition in an early stage company would evolve, and when it becomes pre-IPO, you want to bring on people that are familiar with the capital markets or that are familiar with other aspects of the business that you wouldn't find when the company is early stage. So I believe that the board is not set in stone. The governance is not set in stone. You want to find a mechanism of governance that addresses the current condition of the company at that point in time. Yeah.
In the U.S. and increasingly in European markets, much about governance pretty much fundamentally changes. You will start adding outside board members to conduct the company's foreign policy who are really well-known people. You might change out certain management team members who are much better to address public markets. You will absolutely change an early stage accounting firm for one of the big three, and you will spend 2 years redoing your books to make them IPO-able, and you might change out your law firm for one of the top 10 or so law firms that do IPOs either in the life sciences, a Latham Watkins type firm, or a Wilson Sonsini or another, or a top tier U.S. law firm. So virtually everything about governance will gradually change in the 2 to 3 years as you're preparing for an IPO.
Thanks, Ron. And Garth or Bronwyn, specifically around the transition of the board in conjunction with your own IPO, any key observations there?
Yeah, sure. So we definitely went through a transition. Some board members came off, our pre-IPO board, and new board members came on. And there are a couple of drivers behind that. For example, there are ASX obligations that, we're required to have a certain number of directors in Australia. Also, there's, feedback from the market in terms of how they see the board and how they see, for example, cornerstone shareholders represented on the board. The other thing is it's an opportunity to bring in directors with experience in running a listed company. And so from that perspective, we were very fortunate within our network to be able to bring in and extend our directors, bring in directors with that experience. And so we had a very good board leading into our IPO. We had some changes for compliance with the ASX, and we brought in additional directors that the banking investment community felt comfortable with, and we were a known set of hands. Ron, anything else to add to that?
No, I think that's good.
Yeah. Great, thanks Garth. Lou, how are we going for time? We're done. Okay, great. We are done. Please join me in thanking Tim Bennett in absentia, David, Ron, Garth and Bronwyn. It's been a pleasure. Thank you very much, everyone.